Today, we are going to start the session with Warren Packard, partner of AI Fund. Warren has been in the business for a very long time, and I've known Warren for a very long time, although we haven't had a chance to catch up. So this is a perfect opportunity for us to catch up. Welcome, Warren. Great to see you.
Great to see you too. It is indeed. It's been a long time, but we're doing great, right? Doing the right things.
Trying to do great. I don't envy Tim Cook these days. So
Well, I wouldn't put him low on the bucket, if you will. But we all have, entrepreneurship is a roller coaster, right? So today we don't envy him. Tomorrow we envy him. So it's
Well, and he's had a fabulous run so far. So
absolutely.
So let's focus on AI Fund and what you've been up to. You've obviously switched gears from the last time we spoke. What is AI Fund? What is the thesis, and how have you positioned?
Yes, so we are a bit of a different animal altogether from a traditional venture capital fund. So we are a fund. We did announce the closing of Fund 2 just recently, which is a $190 million fund. But the way that in which we're different is we are a venture studio rather than a venture capital fund. So being a venture studio, we are co-founders in all the companies in which we ultimately invest. So rather than encouraging entrepreneurs to come to us and pitch their companies, we are a magnet for ideas and opportunities and business concepts. And then we take those opportunities and we build companies around them. Most of our limited partners are corporations. And these corporations have all sorts of great ideas bouncing around their four walls that they won't ever commercialize for whatever reason. They're non-strategic is usually the reason, because they certainly would commercialize their strategic companies. But like, for instance, we might hear from the legal department inside a large corporation that there's an incredible inefficiency. And they said that we can see that not only do we have this problem, but thousands of other large corporations have this problem. Let's go start a company to solve this problem. And that's what we do. So on my team, I have 4 business builders. I have 4 technology builders. My partner, Linda, runs recruiting. My partner, Eva, runs legal. And we have all the elements to start and build a company. But really the key to everything we do is hiring a founder. So it's kind of backwards. It's a bit unnatural, where we go out and we find a passionate, smart, driven founder who comes in and builds the company with us. And then ultimately that person takes the business forward as the CEO and off to the races and building a company and getting a product in. I'm sure we'll talk more about that, but we're a venture studio. That's probably the bottom line.
So the obvious question that stems out of what you described is, how do you identify, qualify the founder who's fit for this kind of a model?
Right. That's exactly the pressing question. So just to take one step back, is that once we find this opportunity, we spend about 4 weeks validating the opportunity. We need to make sure that it's a venture scale opportunity, that many different companies, not just one, has this challenge. We look for competitors, et cetera. And ultimately, if it validates and passes validation, we tap Linda and say, Linda, let's get a CEO in place. We call this individual the founder in residence, ultimately. But then they become the CEO after we build. But what are the characteristics of this individual? This is somebody who has built a company before from 0 to 1. It's somebody who is technically very astute. It's somebody who has that intellect and drive and charisma to be a CEO. And it's also somebody who has that subject matter expertise in the domain in which we're building.
Okay.
So we're looking for somebody that has all those elements, but really going back to what qualifies an entrepreneurial CEO, it does come down to that those subjective characteristics of somebody that is super driven, will be able to suffer through the challenge.
Oops, Warren's line went dark. This is an interesting angle that we're hearing from Warren Packard and the AI fund, where instead of founders pitching an investor, we have investors calling for founders. Warren, back to you.
I apologize. The audio went out for a moment, so I only caught the tail end of the prompt. If you don't mind repeating that.
We lost you for a bit, so.
Okay, that was on my end. You lost me.
Yes, so you were talking about you were finding a founder who's driven, and it sounds like you're looking for repeat founders. You're not looking for first-time founders.
That's correct. So I was a managing director of DFJ for 13 years. And in that time, we very frequently were looking for, we were hearing pitches from young founders that had not started a company before. And we were eager and interested and driven to back those founders, in addition to those founders who had experience before. Mm-hmm. However, at AI Fund, you're absolutely correct. We are looking for repeat founders here at AI Fund. Now, that might be a founder who started a company very young, and they're still young, so it has nothing to do with age per se, but it has something to do with experience. We are looking for that experience where somebody understands what it takes. And again, success as a founder is not necessary, but just having lived through an experience, whether for success or non-success, mm-hmm. Is perfectly fine.
So talk about some case studies of problems that you have chosen to double click down on and run this process on.
So, yeah. We now have 46 companies in our portfolio. Those are almost all from Fund 1. So we have a number of different case studies. And I'll point to a few. We co-founded a company called GV Health. And this is actually a primary care healthcare company that is located in India. The whole notion was that accessibility to quality primary care for 1.4 billion people is not evenly distributed. And so how can we take advantage of the mobile phone to provide that first line of care for individuals across India and ultimately across the world? AI, of course, provides a tremendous technology to provide that type of functionality, as long as it doesn't hallucinate. And so we were able to cooperate or co-found this company with a seasoned industrial entrepreneur in India. And we found an incredibly entrepreneurial CEO who went off and trained their own model, large language model that performs at the top of the list, at the Hugging Face primary care medical app. And we were able to just recently launch this company, and we're starting to roll it out. And it is being rolled out in India, and we'll start rolling it out into other countries starting later this year. But it's a very exciting endeavor because it democratizes access to healthcare, which is so important for all the people across the world. And it's a great use of AI. So that's one example of a
So let me ask a question that's, I'm sure, on many minds. Why India? You're based in Silicon Valley. Doing incubation work like this is not easy to do remotely, but you've chosen to do something in India, and that is not even India. The India-US corridor, the India-Silicon Valley corridor is very adept in doing B2B SaaS that is targeting global markets, and now B2B AI that's targeting US markets, global markets, but born in India and validated in India. But now you're going after an Indian B2C play. So tell me more about why did you choose that problem to solve?
It really starts with the people. So we were approached by this industrial entrepreneur, Sanjay Reddy, and he had already built out a fleet of ambulances across India, and I believe servicing about 250 or 300 million people in India. So he had already this knowledge of the healthcare system in India. He had already scaled a business in India. He wasn't going to run this venture, but he had this passion for how do we, it's a double bottom line here. So you're helping the people, plus ultimately looking for a profit. But really, it does start with helping out a population. And because he had this specific domain expertise, and we were further able to find an entrepreneur who's really a global CEO. This is an individual who was born and raised in India, but came here to the United States, and came here to the United States for education. I actually had met him back in the early 2000s when he was at Stanford University. And then he had moved back to India. And it was just the right talent. I mean, this is obviously a very global talent pool that we can tap from. And GV Health is an exception for us. Most of our companies are founded in the United States, but it does, it's a great example of entrepreneurship being able to arise anywhere. And these challenges, well, at the scale, if we can service 1.4 billion people, we feel we can certainly service another 6.6 billion people across the globe, especially since large language models and AI don't really know language boundaries.
Interesting. Okay, let's do a couple of more case studies. It's actually highlighted a lot of points that you are willing to cross geographies and so on, which I was going to ask you about anyway. So go ahead. What else?
Yeah, so another company that I can highlight is a company called ProfitMind. And this is a company that was actually, it started out of another company that we had found, one of our very first companies we founded. We founded a company called Landing AI in the computer vision space. And the idea was to apply machine learning to typically manufacturing situations where you need to do computer vision, you need to look at the quality of products, look at deformations or imperfections, identify those, pull them off an assembly line, repair them, etc. But out of this company, actually, we started leveraging the machine learning to maximize the profit in retail establishments, which sounds completely orthogonal to industrial computer vision. And in a way it was, but a generalized machine learning skill set can be applied absolutely anywhere.
Yes.
That's right. And of course we looked at this and said, wait, we need to separate these ventures. We're finding success in industrial applications with Landing. We're finding success in retail establishments with ProfitMind. And so we pulled it out. And Dr. Mark Crystal was the individual who was at the helm of ProfitMind. This is an individual who had been in retail for many, many years, for decades, and knew the industry well. In fact, this underscores an important point of how we start companies. AI Fund, we are not subject matter experts. We're not vertical industry experts. We know AI and we know how to start companies. We don't know healthcare. We don't know retail. We don't know Salesforce automation. But by working with a founder in residence or a CEO who knows these domains, we can very intelligently approach these markets. And this is the case with Mark Crystal. He knew retail very well. We pulled out the company called ProfitMind, and it is able to go and scour internal information and external information to maximize the profitability of a retail corporation. And this sounds very generic. Of course, there's quite a few companies that want to set out to maximize profitability of retail. But what we found out here with ProfitMind is that they were so far advanced of any other technology company in doing so. We're actually even struggling to figure out the appropriate business model for this company, because the effects on a business are so extreme and so quick that you can't possibly price that in. Like the benefits occur so quickly. So it's been a very...
What were they doing that it was so dramatic and so quick?
You know, and this will get beyond my specific knowledge of ProfitMind. I mean, aside that, because my role at AI Fund is to oversee all the 46 companies. So the one thing that I can say is that the technology that is behind ProfitMind, this predates LLMs or large language models. So it predates ChatGPT. So this is founded on traditional machine learning and deep learning models. And when you're training a model for a specific endpoint or end goal, in this case, profit maximization, there is a bit of uncertainty for how that model is doing what it's doing. It is a bit of a black box because you have all those internal nodes inside a machine learning model. So how is it actually doing it? How was it trained? I would have to, tap the AI engineers of that company. But fundamentally, the part of the secret sauce is data acquisition. Mm-hmm. And if you're pulling in a breadth of data, both internal data, which of course is kept extremely confidential and private for that organization, but also external data that's available by looking around the web for competitive offerings, pricing, comparing one model to another. So you have a complete picture of a market. And when you have a complete picture of the market and you understand the pros and cons of and the capabilities of a certain organization, profit maximization, revenue maximization, customer retention, those variables can be maximized extremely rapidly in an extremely powerful manner. Mm-hmm. So it's been a really fun journey to work with this company as they go into a company. They do have to integrate with the back end so that they get this data feed. And once they're able to integrate with them, the results are stunning, which is very rewarding because it shows the power of AI, not just large language models, which are extremely powerful, but also more fundamental machine learning, deep learning, these supervised learning models.
This company sounds really interesting. Are they beyond 5 million in revenue?
That they are getting there. So the quick answer is no, but they are very quickly approaching that number. So,
I mean, this one sounds really interesting, but I'm sure you have many companies in the portfolio that are interesting, equivalently interesting. We do these Entrepreneur Journey series, as you know, of companies that have at least 5 million in revenue, and we do a detailed study of how they're doing, what they're doing, and it's a very big coverage profile, kind of like a feature story type of coverage. So we're very, very interested in if you want to send introductions and send them in, we would be happy to do the stories. But let me point out a couple of things that I'm hearing here that are going to be really interesting for people listening. Number one is AI is calling to question pricing in enterprise software right now in a big way. Right? Because we kind of settled in, I would say around 99, as the cloud computing wave started, the subscription revenue model, MRR, ARR, predictable revenue, all these, goodies came about. And around 2005, I would say it kind of settled into subscription revenue models, and everybody who was on licensed software models switched to subscription revenue, and Wall Street settled into subscription revenue. So the whole industry kind of organized itself around subscription revenue, software as a service. But with AI, that model is being challenged. Usage-based pricing, outcome-based pricing, there's all kinds of things being considered right now. And as those of you who are listening, as you work through your own pricing models, think about all of that and think about ROI-based pricing that may not be subscription pricing. It may be something else. And there is also a big trend going on right now of human-in-the-loop services. And if you're providing services around AI, and you can charge on an outcome-based pricing, ROI-based pricing models, and those could be incredibly lucrative, multi-million-dollar contracts solving narrow enterprise use cases that hit directly at ROI effectively. So Warren, coming back to what you said about your model, one question that is really central to your model is the question of ownership. I don't know how much time you spend on LinkedIn. Obviously, we're all spending a lot more time on LinkedIn these days. It has become the global water cooler, so to speak, right? So
absolutely,
the discussion about ownership is very present in entrepreneur minds right now, and people are realizing that the earlier you start giving up equity, the more equity you give up and end up with very little by the time you hit a Series C company or a Series D company. So people are starting to become more conscious. Now, in your model, the entrepreneur is being recruited. So what kind of ownership structures are they being recruited with?
I'm glad you asked that question because this is so important. We at AI Fund, we can't just grab equity because we founded the company and we brought in the CEO. We can't just say, oh, we want half the ownership of the company or 60% of the ownership of the company because we started it. We just can't do that. That would break the cap table. That'd break the company. So we always look at ourselves as a minor co-founder of the company. And that founder in residence who comes in and works with us, they always get much more equity than we get. And that one individual gets much more equity than we get. And in fact, just very bluntly, we get half the equity that that founding CEO gets. And then on top of that, there might be equity for another full-time co-founder, let's say a CTO who comes in, and then there will always be an option pool. So we are out of the gate a minority common shareholder, common founder, because if we took more than a small minority stake in the company, it just wouldn't work going forward. It's exactly the reason. We need to be able to bring in a founder in residence who feels ownership for the company, who is the largest shareholder by far, and feels like this is their company. That's key. The other thing I would say, and because you're pointing out, hey, by Series C, Series D, there's a declining ownership. Well, of course, there is always a declining ownership in the company, but maybe perhaps too little remaining for a founder. And one of the great things I see about AI is the ability for a founding team to build and get further faster with less. Yes. You just don't need as much money. And of course, a lot of folks are talking about, who's going to be the first billion-dollar valuation single person company. And I don't actually recommend that. I would say my goal would be the two-person company because it's always great to have a teammate. I would never say you should work alone. It doesn't matter.
Single, double, single, solo entrepreneur. I'm a solo entrepreneur. I've always done solo entrepreneur ventures, but that doesn't mean that you don't have a team. My team has been working with me for 15 years, so more than 15 years. So that doesn't mean anything.
Absolutely.
But I think there is fallacy in thinking in that mode of confusing the market. Like you're going to build a solo unicorn, you're going to build a 3-person unicorn. I think there is fallacy in that. But let's stay on the topic of your model first, and then we'll get to that.
Yes, exactly. And the point I was driving to, whether it's 1 person, 3 people, 10 people, is that you can make a significant amount of progress with AI by your side. I mean, being able to code very, very rapidly by just using prompts to generate your code. We are a product-led organization here. So when we have a 10-week build process because once that founder residence is on board, they remain paired with a business builder, with 2 technology builders. We also bring in a board member as well. And then a 10-week period, that team of 5 is building a company. And every single week, we prototype the product, we put it in front of prospective customers, and we iterate every single week from the very beginning. So we're constantly getting customer feedback, external feedback, and we do that 8 times in our process. And it's very inexpensive. it's very rich in terms of the information that you glean. And by the time the build is over, we very strongly understand the ideal customer profile, the minimum viable product requirements, and we can get to an MVP and get to launching that product very quickly after funding. And it just doesn't take a lot of capital. And that's the key for retaining ownership, is to be that lean corporation. You can do that more than ever.
And you are putting in some amount of capital in this phase, or yeah?
Absolutely. Yeah. So the build phase, that 10-week phase, is actually a fairly nominal amount of money that we put in, because, well, we're putting in a lot of human resources in that, but we also put in some capital to give the founder residents a stipend and pay for some external resources or data or whatever it needs to be done. The larger check gets written after the build, assuming the build is successful, and not all of our builds are successful. And that's where we typically put in $1 million into the company. Or if we have a co-founder, or another co-founder, a corporate co-founder, because we co-build with our corporate LPs, they may also be putting in money at that time. And typically our pre-seed round is anywhere from $1 to $2 million to get the company into launching, get initial customers on board, paying customers, referenceable customers, and then go out for the seed round of financing, where we're looking to raise $3 to $5 million for the company to get it to product market fit.
Okay. And what have you seen? You said you've invested in 46 portfolio companies so far. What are the trends? What are you seeing? Like, how many companies have already exited, perhaps, or, because they're, sometimes companies that have early validation and can hit success early also like to get out early.
That's right. Yeah. So we're still a very young fund. So we're, as I mentioned, we just announced Fund 2. So our Fund 1 companies have been going for some time, but the classic dilemma of raising a second fund for a venture firm is that you really don't have many exits by the time you're raising Fund 2, because frankly, your success stories take on the order of 6 to 10 years to materialize.
Absolutely. By Fund 2, you will not have exits, not that many. I was asking more in that because there is a bit of a trend right now of seed strapping to exit starting to happen. We are seeing a bit more of that. So I don't know if you have started seeing as well within your portfolio, but it sounds like not yet.
Yeah, I mean, we have a couple of companies who have exited. We have one company that was sold to Apple just a few months back. We had another company that was sold to IBM a few months before that. We have a few companies that are out of business because, of course, not everything succeeds. And
of course,
that's right, and that's why we have a portfolio. But we are investing in, as I was mentioning earlier, venture scale companies, and we're looking for these large outsized returns like any venture capital fund would. And so we are expecting these longer journeys.
So you are unicorn chasing fundamentally. Yes.
And all that being said, with a smaller fund, and one could argue, is $190 million a small fund or a big fund or whatever? They don't have to, yes, we're always looking for unicorns. We want to be creating the game changers for sure. But we can have quite a few doubles and triples in our portfolio that do great for us because it is only a $190 million fund. And so if we have a reasonable ownership stake in a company that sells for $500 million or so, that's going to be an extraordinarily pleasant exit for us. But certainly we're looking for those companies that can exceed $1 billion in value and be the seminal companies of this AI era.
Very interesting. I know you have to go. This is a very interesting slice and very interesting slicing of the venture capital ecosystem. So thank you for sharing this with us, and we'll keep in touch. And definitely, if you send us companies, we'll be happy to cover them.
Excellent. Well, it sounds like there was some interest in Profit Mind. I'll send you some more information on that company as well as GV Health. Thanks so much for your time.
Take care. Bye-bye.
All right, Simone. Bye-bye.